We just finished going through Silicon Motion's FY26 Q2 earnings call materials, and now we want to share our takeaways with everyone. And here's the question that kept me up with this one. What happens when the giants come back? Because this company just put up a monster quarter by walking into markets the memory giants abandoned. Revenue up 27%, and one product group went from 4% of revenue to nearly 30% in a single year. That's not a beat. That's a rewritten business. But the whole thing is running against the clock. And I want to show you where that clock stops. The deck frames itself right at the top, and the framing is the argument. Building moats in abandoned territories. That's the title, and it tells you they know exactly what happened here. The stated scope is three things: extreme structural leverage, the AI supercycle vacuum, and the race against the 2028 NAND supply normalization. Sit on that word race for a second. A race means there's a finish line and somebody else is running, and most companies presenting a record quarter do not voluntarily put a deadline on their own slide. Our read, and this is inference rather than anything they printed, is that the whole deck is built to answer one question. Is a moat you got handed the same thing as a moat you built? That's the honest tension in this business, and I'd rather sit with it than pretend the growth answers it by itself. Let's get the scoreboard out of the way because the numbers are genuinely loud. Revenue came in at $451 million, up 127% year over year, beating the $411 million top end of guidance. Gross margin was 50.2% against 48.5% to 49% guidance. Operating margin 20.1% against 21 to 22% guidance, and EPS of $2.43 per ADS, a record high. Beating every single line of your own guidance is not something you see often, but the number the deck actually wants you to hold is on the other side. Ferri and enterprise boot drive revenue went from 4% of total revenue to nearly 30% in exactly 1 year. And the deck's insight is blunt. This is not a cyclical quarterly beat. It's an entirely rewritten revenue structure born from a sudden market vacuum. Born from a vacuum, their words. That's the most important phrase in the whole deck, because a vacuum is something that can close. Now let's be clear about what this company actually sells, because people get this wrong constantly. The deck uses a warehouse comparison, and it's the cleanest way in. The NAND flash makers, Samsung, SK Hynix, Micron, are the warehouse. The physical storage racks, the commodity. Silicon Motion is the warehouse manager, the controller chip plus the firmware, and the deck describes it as the logistics engine that dictates data placement, ware leveling, encryption, and speed. Here's the line that matters. A warehouse without a management system is useless dead space. They don't fabricate NAND. They make NAND function, and the deck calls them the largest independent merchant supplier. So they're not fighting the giants. They're partnering with them to fill gaps the giants cannot or will not fill themselves. Hold on to that second part, will not. Everything profitable in this story lies in the gap between cannot and will not, and those two words have very different lifespans. So why did those gaps open up in the first place? The deck calls it an AI gravity well, and the mechanism is money. NAND makers realized HBM and DDR5 deliver vastly superior margins, so research and capital spending got, in the deck's words, violently reallocated upward. When your own top brass chases the higher margin product, three things get dropped: mobile eMMC and UFS, where giants cede ground to module makers, which boosts Silicon Motion's controller volume. Automotive, where giants abandon a market that demands intense certification support but offers low volume. And enterprise boot drives, where giants refuse to build custom DRAM, less controllers for tiny capacities. 3 abandoned rooms, 1 tenant walking in. And here's the catch the deck puts right on the same page. That same capital flight is causing a severe industry-wide NAND shortage projected to persist until 2028. So the exact thing that handed them the territory is also the thing that starves them of raw material. Now the operating leverage, because this is where I'd normally get suspicious. Operating margin was 23.0% in Q2. Guidance for Q3 is 27.5 to 20.5%, and the Q4 target is above 33%. That's a huge climb in 2 quarters, and usually when you see that, somebody's been cutting. The deck says no. Leverage is driven purely by explosive revenue volume, not austerity measures, and it shows research and operating expense actually rising through the whole period. Cost going up while margin goes up is the good version of this story, and I'll give them credit for showing the spend line instead of hiding it. On cash, reserves dropped from $210.9 million to $181 million, and they explain why $16.9 million in dividend payments plus strategic inventory accumulation to defend against the looming NAND shortage. A cash drop that buys you raw material in a shortage isn't a leak, it's a position. First territory, and this one is winning inside a squeeze rather than winning outright. The bad side is genuinely bad. 2026 smartphone shipments are projected down 10 to 15%, and RAM plus NAND now consumes 50 to 60% of the bill of materials for low-end Chinese smartphones. Half your phone's cost is now just memory, so the result is severe pressure on OEM margins across the industry. So how does anybody win in that? 3 ways per the deck. Low-end immunity, because Silicon Motion has minimal exposure to that hyper-squeezed low-end segment. Vacuum capture, because as NAND makers retreat, third-party module makers gain share, and those module makers drive massive controller volume. And the IoT premium, rerouting eMMC into smart glasses, drones, and set-top boxes, which yields superior pricing power in markets the NAND makers ignore. Same shrinking pie, more slices. That only works while the giants stay uninterested. Second territory, and this is the one I'd rank as the real asset. The barrier here is that module makers lack the infrastructure, the resources, and the brutal certification processes required for automotive-grade products. The deck says Silicon Motion has spent a decade building that certification wall and currently supports 3 NAND makers with proprietary automotive controllers. 10 years of certification research is a very specific kind of moat. You cannot write a check for it, and you cannot rush it because the clock is the barrier. Then there's the call option sitting off to the side. They're engaged with US and Chinese humanoid robotics developers. And the deck notes each unit requires multiple controllers for vision, LiDAR, and balance. The timeline they give is drones first, with robotics scaling heavily in 2029 to 2030. Our read is to value that as optionality and nothing more, because 29 is 4 years out and nobody's numbers are real that far ahead. Third territory, and this is the one that rewrote the revenue mix. Every AI server needs a small utility drive just to load the operating system, and the deck's target is a 256 GB RAM, less boot drive. Now look at what the giants actually sell, 16 to 30 terabyte enterprise data drives. The economic shield the deck describes is simple. It is not economically viable for a titan to dedicate research to a tiny 256 GB controller when their core business is drives 100 times bigger. It's the steakhouse problem. Nobody with a prime rib operation wants to staff a line just to make the side salad. And then the multiplier. A single AI server rack demands 30 to 40 or more boot drives, and the deck says they're winning allocations across DPUs, TPUs, telecom, and command significant NVIDIA Bluefield supply. Tiny product, enormous unit count. That's how 4% becomes 30% in a year. Now the part where they're actually attacking rather than filling gaps, and it's stuck. On demand, MonTitan has 2 Tier 1 clients in mass production, now with 5 more scaling in the second half. The target is 5 to 10% of total revenue by year end, and overclocked Tier 1 clients are waiting for 4nm PCI Gen 6 samples. That's a genuinely strong order book. On supply, the industry is starved for 2 TB QLC NAND because NAND makers diverted capital to HBM and stalled QLC maturity, and the deck says the ultimate catalyst for MonTitan is 1 TB and larger QLC drives. The CFO's clarification is the line to remember. Our controllers are ready. This is an industry-wide NAND availability issue. To be fair, that's exactly what a company would say if their product were the problem, so I don't take it at face value. But 12 Tier 1 clients queuing for samples is hard to fake, so I'm maybe 70% that the constraint really is upstream. Give them credit here because these 2 headwinds came from management, not from a critic. Headwind 1 is the 2028 shortage. The AI supercycle is inflating costs across HBM, DRAM, NAND, and hard drives. OEMs cannot build affordable low-end PCs or smartphones. And management's outlook is that scarcity and a challenging NAND environment persist until 2028 when new fabs come online. Headwind 2 is what the deck openly labels a management miscalculation. The PC transition from PCI 4.0 to 5.0 is moving slower than they projected 6 months ago, because OEMs are pairing newer NAND with older 4.0 controllers to suppress bill of materials costs in value PCs. Calling your own forecast a miscalculation on a record quarter is not normal behavior, and I notice it. The mitigant they give is real too. They captured massive PCI 4.0 share across both NAND makers and module makers, driving edge SD growth of 50% year over year despite the PC slump. Being wrong about the transition and still winning the segment is the best possible version of being wrong. So can you trust the people telling you this story? The deck weighs it both ways, which I appreciate. On the transparency side, 3 things. Margin discipline, because they refuse to bait analysts by raising the long-term gross margin target of 48 to 50%, despite printing 50.2% this quarter. An unprompted dilution warning, where the CFO volunteered that MonTitan's average selling price will be lower than boot drives. and the research confession where the CEO bluntly stated they lack the resources to support the influx of projects. 3 chances to oversell, 3 declined. Then the red flag, and it's a real one. Management explicitly refused to break down the exact revenue split between the automotive line and enterprise boot drives, protecting their most lucrative competitive vacuum. The charitable read is that telling everyone exactly where the gold is buried invites company. The uncharitable read is that you can't verify the mix that the entire bull case depends on. Both readings are fair, and you should hold both. Now let's translate what was actually said, because the deck lines up 4 quotes against its own second level read. Management said they're in the very early stages of a complete transition, and the deck's read is to change your valuation framework. It's because that 4% to 30% shift proves this is no longer just a cyclical PC and mobile chip designer. Management said NAND makers have no interest in these markets, giving stronger pricing power, and the read is sharper than the quote. High margins come from strategic battlefield selection, not technological dominance, and the moat lasts only as long as the NAND makers stay away. That's the most honest sentence in the entire deck. Management said as long as they can secure NAND supply, boot drives are the crown jewel, and the read is that the absolute ceiling on the fastest growing business is dictated entirely by raw material allocation. And on a silent nod, the CFO did not deny a 2027 projection that these lines hit 1/3 of total revenue, which the deck treats as tacit confirmation of the structural model. Here's the page I'd screenshot because it grades its own moats instead of just claiming them. Automotive is rated secure. The barrier is time and certification, 10 years of it. Vulnerability to the cycle is low, and the deck says flatly this moat cannot be bought or rushed. Enterprise boot drives are rated stable. The barrier is economic, the density mismatch, vulnerability is moderate, and it holds as long as AI servers keep demanding low-capacity utility drives and raw NAND is available. Mobile eMMC and UFS is rated vulnerable, and read this one twice. The barrier is described as opportunistic, meaning NAND makers are distracted by HBM. Vulnerability to the cycle is high, and if the memory cycle flips and HBM margins compress, the giants may pivot straight back. So one wall is built, one wall is economics, and one wall is just somebody else looking the other way. Grading your own weakest position as fragile in your own deck is rare, and it's why I take the other 2 ratings more seriously. 4 alerts, and the CEO quote sitting in the middle of them is the one that stings. We don't even have enough research resources to support so many projects. That's the chief executive on a record quarter. The human capacity limit is the first alert, and the deck puts it well. Explosive demand is useless if engineering headcount cannot scale linearly, and that's a harder physics problem than building a fab. You can pour money into a fab, you cannot pour money into experienced firmware engineers. Second, margin dilution. Boot drives, meaning controller plus NAND, grow fastest, and that structurally dilutes the pure play controller gross margin back toward the 48 to 50% baseline. Third, the 2028 macro squeeze, where the consumer divisions must survive a hyper-inflationary component environment for 2 more years. Fourth, the cycle reversal, and it's the strangest one. This company's operational cadence is now inversely pegged to memory makers' capital allocation, not to end consumer demand. That means you stop tracking phone sales and start tracking somebody else's spending plan. So here's the closing argument, and it's admirably unsentimental. The deck states that this hypergrowth is a byproduct of a specific industry anomaly, and the mandate is to convert these abandoned territories into impenetrable strongholds before NAND supply normalizes in 2028 and the giants look for new revenue streams. Then 5 things to check over the next 4 quarters. Does the structural mix hold? Meaning, do those 2 lines sustain above 30% of total revenue? Does MonTitan hit the 5% revenue target by Q4? Does operating margin officially cross 30% by year-end? Does gross margin settle back into that 48 to 50% reality zone, which would prove the dilution is being modeled correctly? And do those 12 or more tier 1 clients waiting on Gen 6 samples convert into actual design wins? Alright, last thing, radar always leaves you a light. I'm calling this one yellow. The execution is genuinely excellent. Beating every line of guidance and rewriting 1/3 of your revenue mix in 12 months is not luck, and the automotive certification wall is a real asset I'd pay for. What holds me back is that the company itself calls this an anomaly with a 2028 deadline, grades its own mobile position as vulnerable, and tells you the margin dilutes back toward 48 to 50% as the good business grows. It's like opening the only diner in a town the chains pulled out of. Terrific business, right up until the chains decide to come back. If those two lines hold above 30% of revenue and MonTitan actually lands the 5 to 10% target by Q4, that's the vacuum turning into a stronghold. And I flip to green, and I'm telling you that up front. If you like this kind of analysis, the kind that does not ride the market's mood and stays locked on industry data and hard logic, please subscribe to Value Stock Radar, hit the bell, like and share. Your support is what keeps us digging through the financials and hunting down quality names. This is Value Stock Radar. See you next time.